Today, I am going to show you the 3 housing charts that you need to be monitoring right now. So this video is going to be a little bit different than our normal Macro Monday style videos. Less of teaching a topic and more of showing you 3 really interesting charts. So if you're interested in this style, please comment down below and let me know. And I can try to do some more of these as well as mixing in our normal educational style videos. So selfishly, I wanted to make this video because I myself am in my early 30s. And so I'm starting to think about owning a home. And unfortunately, it is really expensive right now, and mortgage rates are really, really high. So I've been monitoring some of these housing charts, and I thought it would be a really good shakeup from the normal sort of inflation, Iran topics that I'm sure you're reading and watching a lot of content about. So, 3 housing charts. We're going to start with this one. So, housing simple supply and dynamics. Do they hold? So what you can see right here in this chart is this is 2 really cool series from Redfin. The blue is the estimated number of buyers. So how many people they estimate right now are actively trying to buy a home in the US, and the estimated number of sellers. So again, they're estimating how many people they believe are actively trying to sell their home. And when you put these 2 series together, you can see that there's a huge disparity right now between the number of sellers and the number of buyers. So you may be thinking, oh, wow, great news. If we talk about normal macroeconomics, microeconomics, supply and demand curves, when the supply of something is greater than the demand, you would expect prices to fall. However, as we lead into chart 2 here, housing dynamics are not that simple. There is a huge behavioral economics component to the housing market. And just from a high level here, it kind of makes sense, right? Houses are generally the largest asset on someone's balance sheet, on your personal balance sheet, as well as the most amount of debt you will ever take out in your life. So finance can be a very emotional thing. So it makes sense that the housing market is beholden to the emotions of homeowners and home buyers. And in particular, there are 2 behavioral economic components. They're very relevant here, and that is anchoring bias and the loss aversion. So anchoring bias is when an individual anchors a prediction or a forecast to a number they were predisposed to. So for a housing standpoint, that could either be the price that they bought the house at, the price that they initially listed the house at, or it could be the price that their neighbor's house down the street sold for. So for example, if your neighbor sold their house for $1 million, you're going to think that your house is worth close to $1 million, anchoring that number to what your neighbor sold for, regardless of how realistic that is in the current market conditions, right? Your neighbor could have sold their house 3 months ago, but you're still probably going to think that you deserve somewhere in that ballpark if your houses are similar. The other is loss aversion, very similar to anchoring bias in some ways, because you are anchoring to the price at which you bought the house at. So it has been studied that people really hate taking losses. Gains and losses of equal magnitude, people really hate those losses more than they enjoy the gains. And so what this means is there have been academic papers specifically looking at the housing market where home sellers will typically unlist their home or not seriously consider actually selling their home at prices below what they purchased it for, regardless of what the market is telling them. So if a homeowner bought their house for $1 million and they wanted to sell their home, if the market was saying that their house was worth $900,000, they would be unlikely to sell regardless at that number, just because they purchased it for $1 million. And this chart here shows a little bit of those 2 dynamics, where typically you would expect the median new home sale price, so that is in blue, to exceed the median existing home sale price. And the reason for that is because with a newer home, right, you're expecting the newest technology, the newest standards. You're less likely going to need to replace something. right? So if I'm buying a home that was built last year versus buying a home built in the 1950s, there's a bigger chance that I might need to replace something soon in the house that was built in the 1950s. So that's going to be an additional cost incurred onto me as a part of buying that home. So typically, you expect new homes prices to be higher than existing home prices. But recently, that is not what happened. What has happened? So while you have those supply and demand dynamics, where there's more sellers than there are buyers, people are still unwilling to drop the price of their existing home because of these biases that I sort of put in the right here. There are a variety of other reasons as well, but I typically view this as a behavioral finance or a behavioral economics issue. So what needs to happen? Well, the big issue here, on top of those behavioral dynamics, is the lock-in effect. So during ZIRP, or zero interest rate policy, mortgages, a lot of them ended up being sub 3%. You can see the spike here for a really long time, right? This number was about 3 to 4% of all mortgages were sub 3%, and that spiked all the way up to 25%. And so what is the lock-in effect? That is where homeowners with low mortgage rates are discouraged from selling their homes because they would then need to refinance a new home at the higher mortgage rate. So even if you were going to downsize and try to buy a cheaper house than the one you currently lived in, if you were going to take out some sort of mortgage, you could have seen an increase in your monthly payment if you were going from a 3% mortgage all the way up to a 6 or a 7% mortgage. And so what did that mean? That meant a lot of people with these low mortgages were not willing to sell their home because it was going to be more expensive for them to go into a new home. What we are seeing recently is mortgage rates have now been high enough for long enough. They're going back up now over the last few weeks as well, but they've been above 6% for quite some time. I believe they hit 7 or 8% even at their peak recently. That a greater proportion of those mortgages or of the outstanding mortgages are now greater than 6%. So there are more people now with mortgages greater than 6% than there are with mortgages below 3%. So what does that mean? Well, as more and more people have really high mortgages, the lock-in effect sort of goes away. So there are going to be less homes that are tied up in really cheap mortgages. So a few years down the line, these people with mortgage rates that are 6 or 7%, they might be more likely to sell their home, which could free up some inventory. And you might see sort of prices potentially come down from there as more of these people are willing to sell their homes and potentially lock in lower rate mortgages if they have not already refinanced, depending on how the 30 rate mortgage performs over the next few years. So that'll be something we'll be watching closely. So I hope you enjoyed. Again, I just wanted to show you 3 charts, housing charts in particular, that I thought were interesting. If you like this style of video where I just show you some cool charts and it's less of like a specific teaching lesson, let me know in the comments. This is something I can certainly integrate more into our content. So again, I hope you enjoyed, and I'll see you back here next week for another Macro Monday video.